Where are the cap rates right now, and what are the distinctions in the cap rates from region to region?
Well, overall, when you're looking at multi-tenant retail, you have different subclasses in there. You have your core plus real estate, you have your anchored real estate, you have strip retail, and then you have single tenant net lease. What we're finding is that there is anywhere between 150 to 250, 300 basis points between infill locations, coastal properties, to secondary and tertiary markets. What I mean by that is, for example, in California, we see the biggest cap rate compression in retail versus Texas, versus Missouri, versus Illinois, Indiana, for two reasons. One, we have the demographics, we have the population, and we have quality of lifestyle here. We see movement in rents in California where we don't see that in other parts of the country. So therefore, the cap rates are a lot lower. So in areas like secondary markets of Texas, you'll have 150, 200 basis points higher on cap rates, but you don't have the rent growth that you see in like you would have on the West Coast. Therefore, you have capital that crosses borders now and will chase yield if that's important to them. And with technology and quality management, people that live in California own outside of the state.
Where do you see cap rates going generally over the next year to a year and a half?
Right now, we're seeing cap rates on certain asset classes compress because of supply and demand. And it's strictly that there isn't enough inventory and you have a majority of buyers that are chasing that inventory. As a result, people are paying more just to get control of the real estate. It has nothing to do with economic conditions. It's a supply-demand issue. When you look at the amount of buyers in the marketplace that have taking their equity from other investment classes and looking at real estate as a hard asset. So they've taken money out of the bond market, taken money out of the stock market, or have liquidated other real estate asset classes for various of reasons. And there is relatively limited inventory available. The competition is fierce, and you have multiple offers and on assets, and therefore it just drives value. When you look across the country and you see, okay, why are people selling today? Well, they've maxed out their real estate in terms of occupancy, in terms of rental growth, and they're taking advantage of strictly the demand in the marketplace. So where do I see cap rates in the near term? Relatively the same, if not flat. If we see changes in Fed's policy with interest rates, we will see changes in cap rates. Now, there's usually a 30 to 90-day lag period behind that because you have the bid-ask not meeting. In other words, sellers' reaction to the marketplace is a lot slower than buyers' reaction in their underwriting. So the syndrome of catching a falling knife comes into play here, where the seller says, well, wait a minute, I got an offer 90 days ago, I want that offer now. Well, actually the market has shifted and your property's worth a lot less. So it all is a function of where interest rates are going to be going in the future. I think it's safe to say, Howard, that we will see a higher cap rate market 6 months, 12 months from now.